Hi everyone, thank you for joining us. I'm Alex, the moderator for today. Today, we'll talk about a very important topic called monetary policy and central bank independence. Why is monetary policy important? Monetary policy can shaping economic stability and support economic growth, and this is managed by the central bank of each country. Central bank have power to influence the interest rate and control money supply. So let's start with discussing the role of central bank in controlling inflation. Who can share their opinion?
So I will, and I'll be talking about the role of central bank in controlling inflation. So the central banks play a crucial role in controlling inflation. They're constantly watching inflation data, prices, wages, and more to decide when to act in order to keep inflation stable. And so what do central banks actually do? Central banks control inflation mainly through monetary policy. So monetary policy is the actions taken by the central bank to control the money supply and interest rates to achieve economic growth, basically by making it more or less expensive for people and businesses to borrow and spend money. Firstly, they control the interest rates. When inflation is too high, central banks raise interest rates, which makes loans more expensive and people and businesses borrow and spend less. Less spending means lower demand, which helps to slow rising prices. If inflation is low, they lower the interest rates to increase spending and investment. As mentioned, they also control inflation through controlling and managing the money supply. They do this through buying or selling securities in the open market. This controls the amount of money in circulation, preventing excessive money supply, which is a factor in triggering inflation. An easy way to remember this is thinking of it like using brakes on a car. So basically, when the car is too fast, meaning the inflation is too high, the central bank will press the brakes, meaning they'll raise the rates. But when recession is happening and the car is too slow, they'll ease off the brakes and lower the interest rate.
But does raising interest rates make it harder for people to buy homes and start businesses?
True, but the goal is balance. Good inflation that is not without facing good. It's tricky. Inflation is a storm, but central bank have tools such as interest rate to calm it down.
Thank you for the amazing discussion. So, how do central bank control inflation? Are there any tools they use?
Yes, of course. So let's talk about two of the key tools of monetary policy. And the first one is interest rate. This is quite similar to Jasmine point. So there are two types of policy, which are expansionary and contractionary. So in expansionary, when interest rates are too low, borrowing becomes more cheaper. This encourages consumers to spend and businesses to invest, boosting economic growth and reducing the unemployment. On the other hand, when interest rates are high, borrowing costs increase. This discourages spending and investment, helping to control the inflation. So interest rates influence the cost of borrowing, levels on investments, and even government and consumer spending, making it a powerful tool for managing the economy. Moving on to quantitative easing or QE, it is a monetary policy used by central banks like the Federal Reserve when short-term interest rates are near zero and economic growth and inflation remain persistently low. First, the central bank buys financial assets like government bonds from the commercial banks. These purchases inject new money into the economy, increasing bank reserves and expanding the overall money supply. With more reserve, banks are encouraged to lend more to households and businesses, boosting spending and investment. So far, do you guys have any questions?
I get your point, but why do some people criticize about the quantitative easing?
This is because although QE can boost the economy, too much of it might lead to inflation or make the rich richer since it raises the value of assets like stocks and bonds, which not everyone owns.
Oh, great point. But for this tool to actually work effectively, something very important is needed, central bank independence. Let's hear more that from Sasha.
So I will explain about importance of central bank autonomy. Central bank independence is essential because it builds credibility, which means people believe the bank will do what it says, especially in keeping inflation low. When central bank is free from political influence, it can make objective decision based on what's best for the economy and not what's popular. This helps inflation expectation because business and households trust the bank to take action when needed. A credible and independent central bank doesn't need to overreact to every situation. Sometimes just announcing a policy is enough to influence market because people trust the bank follow through. Without independence, people may start to doubt the central bank. They might think the bank will print more money to help the government, which can lead to higher inflation. That's why independence helps the central bank manage the economy more effectively and give people confidence that monetary policy is being used responsibly and consistently.
So, what could happen to inflation expectations if the central bank isn't independent?
If the central bank isn't independent, people may fear it will follow political pressure that make them expect higher inflation, which can make inflation rise even faster.
How does the loss of credibility affect the overall economy?
It forces the central bank to act more aggressively, like raising interest rates sharply, which can slow down the economy and increase job loss.
Thanks for the insight. Independence is important, but even then, coordination with fiscal policy poses many challenges. Let me share some of the challenges. I will just focus on the common case when both policies are expansionary. In the ISLM diagram, show output rising with stable interest rate when both policies are expansionary. But in reality, one policy usually dominates, affecting the overall outcomes. The first challenge is the risk of supply-driven inflation. This occurs when prices rise due to decreasing in the supply of goods and services. In some cases, if monetary and fiscal policymakers respond to this to stimulate demand that adopt expansionary policy might unintentionally worsen the inflation. This misalignment shift the AD curve to the right, while AI stays stagnant and lead to higher price without a corresponding increase in the real output, and thus reducing the purchasing power. The second challenge is the central bank independence straighten. When both policies are expansionary, the government may put pressure on the central bank to lower the interest rate, as government want to decrease their debt servicing costs. If the central bank gives in, they might lose its credibility. Is there any thought or question on this subtopic?
Is it too narrow to just focus on case when policy are expansionary? In the US, after COVID, fiscal policy was expansionary, but monetary policy tightened.
True, I only focus on a common case, but mixed policy, like you mentioned, show that how conflicting goals can reduce the overall effectiveness of both policy.
May I add on? It gets worse when governments spend more before elections, making inflation even harder to control.
Exactly, and that's why central bank independence is so important, like mentioned by Sasha, so that they are not influenced by the political pressure. So we were seeing how coordination can be tricky, especially after COVID. I've been wondering how effectively monetary policy was in post-COVID area in Malaysia. So let's find out.
During COVID, the economy slowed down a lot. People lost their jobs and many businesses struggled to survive. After the pandemic, the government and central bank took quick action. They injected more money into the economy and banks lowered interest rate from 3.00% to 1.75% during COVID time. This made it easier and cheaper for people and businesses to borrow money, to buy homes, invest in businesses, and keep spending.
But are there any side effects that monetary policy brings?
Yes, over time, as people keep spending, prices begin to rise. This led to inflation. In Malaysia, inflation hit 3.3% in 2022, making essentials like food, rent, and fuel more expensive.
Did it also affect wealth inequality in the country?
Definitely. Low interest rates made asset prices like property and stocks rise, which mostly benefited wealthy individuals who already owned these assets. So this created a wider gap between the rich and the poor and led to more inequality.
Thanks for a great explanation on the post-COVID monetary policy. Let's finish out by summarizing everything. In short, monetary policy and central bank independence are crucial for economic stability. Thus, a strong coordination with clear boundary between fiscal and monetary role are essential to ensure the long-term sustainability of a nation economy. Thank you.